Hello everybody, and welcome to the presentation on unrelated business income tax, or UBIT, in IRAs and other tax-exempt organizations. My name is H. Quincy Long, and I'm CEO of Quest Trust Company, a premier provider of self-directed IRAs and other accounts. And we're going to do a little education today and give you some food for thought. I feel this is an important topic. But before I proceed, I of course want to have my disclaimer, which is that Quest Trust Company does not provide tax, legal, deal structuring, or investment advice, or endorse any products, services, or investments of any type. So all information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of transaction or investment. And that would, of course, include unrelated business income tax type transactions, which we're going to discuss today. So what types of plans can incur unrelated business income tax? Well, virtually everything that we offer here at Quest as self-directed accounts can be subject to taxation in the circumstances we're going to discuss. So that would include the traditional IRA, the Roth IRA, the SEP IRA, the simple IRA, the individual 401k, and the health savings account and Coverdell Education Savings Account, or CISA, are all going to be subject to taxation if you do some of the activities that we're going to describe for you today. And that may be okay. That's just hang on and pay attention. You'll learn something, I promise. So America is said to be the land of opportunity. I think that's certainly true. And basically, that means everybody can become a taxpayer, and that includes your IRA or other self-directed account. So how is it that IRAs have to pay taxes? Because it's in the circumstances where they have something called unrelated business income tax, or UBIT as we call it, which is really broken down into unrelated business income and unrelated debt finance income, as we'll see in a minute. But those are the types of transactions that will cause your IRA, not you personally, to owe taxes. Let's see how it works. So there's three categories mainly that could cause your IRA to owe taxes. One would be owning a business either directly or through a non-tax entity. Now it's pretty rare for an IRA to own a business directly because by definition you don't usually have employees in an IRA. So, but they often might own a business or operate a business through a non-tax entity, such as an LLC taxed as a partnership, or a grantor trust, or something like that. So, as an example, my 401k does own a part of an LLC. It's a small part, a part of an LLC, which in turn owns and operates a restaurant business. And so because it's an LLC taxed as a partnership, that income flows through to the 401k and is part of its annual 990T tax form. But that doesn't affect IRAs too much. The second thing is renting personal property. Now the weird thing is that renting real estate that's paid for in cash is not subject to taxation to an IRA, but for whatever reason they made renting personal property subject to a tax. And so when you think about that, a mobile home in Texas, at least where I'm recording this session, a mobile home can either be real estate or personal property, can even switch back and forth between owners depending on how they register it and whether they own the dirt underneath it. So a mobile home in a park where the mobile homeowner doesn't own the dirt underneath it is going to be registered as personal property, whereas a mobile home on land out in the country where the IRA or the owner might also own the dirt underneath it could be registered as real property. And in one circumstances, if it's personal property, it's going to be subject to taxation in the IRA, and if it's real property and there's no debt against it, it's not going to be subject to taxation. Go figure, that's the rules. I'm not here to explain why the IRS does what they do, just to give you some education. Now, the thing that IRAs do run into is debt finance capital gains and debt finance rental income from property, real estate that has a loan on it, and that's again either directly or indirectly through a non-tax entity. So we're going to go over how this all works during the presentation, but that's the overarching scheme. Now don't be confused about one thing. I want to be clear about this. If your IRA pays cash for the property, there is no tax on the income from the investment to the IRA. So don't get confused when we start talking about debt finance property. In a moment, you'll see that the IRA has to pay taxes on some of it, or might have to pay taxes on some of its income. That's not true of real estate in general owned by the IRA. So don't get too excited when you see the latter part of the presentation. So we have this kind of flow chart here, and unrelated business taxable income is broken down into two different pieces, and one is unrelated business income, the other is unrelated debt finance income. And unrelated debt finance income is broken down further into regular, like rental type income and capital gains. And capital gains are broken down further into short-term and long-term capital gains. So it's kind of an advanced or an involved scheme, and each kind of income is taxed differently. We're going to go over some of that, but basically I wanted to just give you an overview here, because this is going to be something your CPA is going to be figuring out for you when he does the 990T, or she. So as we mentioned, this can affect income from pass-through entities, and again, what I mean by pass-through entities is any entity that doesn't pay its own taxes. So like in partnerships, LLCs that are treated like tax-like partnerships and grantor trusts, the income flows through to the owners of the entity, and that would include your IRA, so that the activity of the entity is as if it's activity directly in the IRA. So let's get into some definitions here. Unrelated business income, or the first prong that we're going to cover, is income from something called a trade or business. And that trade or business is regularly carried on by an exempt organization or account in our case, and it's not substantially related to the performance by the organization of its exempt purpose or function, except that the organization uses the profits derived from the activity. So what does all that mean? Well, we're going to go over each of these terms and make it more clear what they're talking about, what's going to be taxed. So a trade or business is simply any activity carried on for the production of income from selling goods or performing services. This is not a terribly confusing definition. Any activity carried on for the production of income from selling goods or performing services. So that's the first test. The second test is it has to be regularly carried on. This has some interesting implications in the IRA world, but basically something is regularly carried on if the activity shows a frequency and continuity and are pursued in a manner similar to comparable commercial activities of non-exempt organizations. So what that means is, for example, if you have an university which is an exempt organization, and that university owns a pizza joint on the corner, then that pizza joint, if it didn't have to pay taxes on its income, it could unfairly compete with the personally owned or non-IRA or non-exempt owned pizza shack down the street. And also they want it to be regularly carried on because they're not going to mess with something as little as renting out the parking lot during a fair or something like that. But if basically it would have been competing unfairly with other non-exempt organizations' income, then they want to tax it so that everybody's on a similar playing field. Business activity, the third prong, is that the business activity is not substantially related to an organization's exempt purpose if it does not contribute importantly to accomplishing that purpose other than through the production of income. So if you think about that for a minute, if a university, a state exempt university owns that pizza place, the selling of pizza is not contributing importantly to the accomplishment of the university's exempt purpose, which is to educate the students at the university. But if it was related in any way to the exempt purpose, then it's not going to be subject to taxation. So think of the situation where a museum of natural sciences sells books related to dinosaurs. Well, that's subject to its exempt purpose, which is to educate the public on dinosaurs. But if it sold cookbooks or something, that's not going to be substantially related to the purpose of the organization. Of course, this just really doesn't do anything for IRAs, because IRAs are really, the exempt purpose is to produce income, and that's not going to be an exempt purpose that's permissible under this prong. So what is excluded from unrelated business income? So what we saw here is that the things that are investment type income are what's excluded. So dividends, interest, annuities, and other investment income, royalties, including overriding royalties, rents from real property, and I'll add in here, as long as they're paid for in cash, which we'll get to in a minute. Gains and losses from the disposition of property. Well, that's nice, but note that it says, except primarily held for sale to customers in the ordinary course of a trade or business. So let me slow down there for a minute and go over that. You can buy a property in an IRA, a piece of real estate, and pay cash for it, and later sell it at a profit. That's no problem. Unless basically you're a dealer in real estate in your IRA, because property that's held primarily for sale to customers in the ordinary course of a trade or business is not capital gains income. Basically, that's investment income. That's business income. So if you think for a minute, if you go down the freeway and see something that says, we buy ugly houses. Well, to the ugly house buyers, that a piece of real estate is merely a piece of inventory, because the inventory that they buy is for sale to customers in the ordinary course of their trade or business. So you got to be careful with flipping property in an IRA. It's fine to buy it, it's fine to sell it, but you don't want to make it a trade or business. The same thing goes with the lapse or termination of options, if options are written in connection with investment activity. I think people listening probably know about options. If you don't know about options, that's a great class that we teach as well. But they're talking about if you're an options dealer, in other words, if you get, all you do is get options and sell off the options, or wait till they lapse or terminate to count the income from selling the options. That's not investment activity if that's all is, if you do it with a regular continuity. So be careful using options if you think you're going to just put a $100 option down and put $99,000 in profits in your account and never close on any options that you buy. That's going to be treated as not investment activity but business activity. And investment income, this is where we go into the other prong now. Investment income, which would otherwise be excluded from unrelated business income, like we've just seen there, must be included to the extent it is derived from debt financed property. The amount of income is proportionate to the debt on the property. So think about that for a minute. If you have a property that's debt leverage, if you have a property, let me put it this way, if you have a property that's paid for in cash with your IRA, there's no debt financing on it, the taxation from the gain or loss or the income from it is not going to be subject to taxation, right? Because there's no debt on it. But although it is excluded generally from unrelated business income, to the extent it is attributable to debt, that portion of the profits are going to be subject to taxation in the IRA. So let me give you an example. Suppose that your formula that we're going to come up with in just a minute here, your formula says you're 70% leveraged on average during the year, and you make $10,000. And I'm oversimplifying a bit for purposes of example, so please understand. That means that the 30% that your IRA paid cash out of its own pocket is going to be free from taxation in the IRA, because that's the IRA's money that's been put up to do the deal. The 70% that's debt leverage is somebody else's money, not the IRA's money. And the IRS says, well, we're only going to let the IRA get away with not paying taxes on the part that it puts up in cash. The part where it's using somebody else's money, well, we're going to tax that because that's only fair. We didn't promise you could use other people's money in the IRA and be tax-free, only the IRA's money. So in this case, they're going to tax the debt finance portion. And again, the amount of income that's subject to tax is proportionate to the debt on the property, which we'll see in the formula in a minute. So debt finance property means any property held to produce income, including gain from its disposition, for which there is an acquisition indebtedness at any time during the tax year of the 12-month period before the date of the property sale. Acquisition indebtedness then is the amount of unpaid debt incurred when acquiring or improving the property, before acquiring or improving the property, if the debt would not have been incurred except for the acquisition or improvement, or after the acquiring or improving the property, if the debt would not have been incurred except for the acquisition or improvement, and incurring the debt was reasonably foreseeable when the debt was acquired or improved, when the property was acquired or improved. So you see, the acquisition indebtedness is just not the money you borrow, for example, to buy the property. That makes sense and everybody understands that. But if you borrow money to buy a property, then that's still going to be acquisition indebtedness to the property you buy. And if you buy a property for cash but later want to improve the property, as long as it was foreseeable that the property was going to need improvement, then that's going to be acquisition indebtedness as well. And acquisition indebtedness includes not only borrowed funds, but property acquired subject to a mortgage. That's very commonly done in IRAs. And other liens similar to a mortgage, such as deeds of trust, conditional sales contract, chattel mortgages, UCC security interests, pledges, agreements to hold title in escrow, and I like this last one, is important, liens for delinquent taxes or assessments. So a property with a bunch of delinquent taxes on it, those delinquent taxes are considered debt financing on the property. So how do you calculate this mysterious acquisition indebtedness, or your unrelated debt finance income? Well, again, it depends on what type of income it is. But in the debt finance realm, it's the average acquisition indebtedness divided by the average adjusted basis. Now, this is going to be a bit confusing to some people who are not used to those terms, but don't worry too much about it. Your CPA will be able to figure this out for you. But in general terms, the term average acquisition indebtedness is you look at the acquisition indebtedness on the property for each month you own the property, add them, if you've owned it for the whole year, add them up all together and divide by 12, and that's your average acquisition indebtedness. The average adjusted basis is the basis you have in the property at the beginning of the year plus the basis at the end of the year divided by 2. Now what's going to be that? Because with basis, you've got what you paid for the property plus capital improvements minus depreciation. So that number is going to fluctuate on the bottom. And you simply multiply that times the gross income from debt finance property and also the expense income, the expenses from the debt finance property, and do that multiplication, and that's going to give you your factor. Now, capital gains is taxed a little bit different. In capital gains, you're going to look at the highest acquisition indebtedness in the prior 12 months divided by that same number, the average adjusted basis. Now, the highest acquisition indebtedness is different than the average acquisition indebtedness in the prior formula. So what that could mean, though, is if you had debt on a property and you paid it off in your IRA and then didn't sell the property for more than 12 months, then you're not going to have to pay any capital gains taxes on that property. So that can be a strategy. I had one guy that bought a piece of real estate, and there was going to be no income from the real estate. He just bought it for investment purposes, and he arranged with the seller financing to make annual payments, and the annual payments were less than he contributed to the account. So even though it was debt financed property, as long as he paid the payments and had no income and waited at least 12 months, he paid no taxes on the gains from that property. So that's kind of cool. Now, I mentioned that these are for IRAs and Coverdell Education Savings Account and Health Savings Account. They also apply to individual 401ks, but there is one special limited circumstance where a 401k can be exempt from the taxation of unrelated business income and debt finance income. That's found in Internal Revenue Code section 514C9. Now, this does not apply to business income. This is only applies to non-business income, and that means debt finance property that you may have held for not for sale to ordinary course, sale to customers in the ordinary course of trade or business. In other words, flipper property, if it's debt finance, doesn't get this exemption, but if you have long-term hold property, like an apartment complex where you have seller financing, then this can be a very useful tool. But I don't want to overemphasize this because this exemption does not apply to IRAs. It's only for 401ks, and it's a very particular set of circumstances you have to qualify for this section. But if you have an individual 401k and you want to use this section there as a reference, and you might want to look that up and discuss it with your CPA or tax advisor. Now, some people say, well, I don't want my IRA to pay taxes, and I understand that, really, but is there ways to get around this tax? I'm always asked by people how to get around something. Well, there are actually solutions to the UBIT problem, if you want to call it a problem, but they have their issues with each solution. So, for example, you can invest in a business through a taxable entity. Is that okay? Sure. The IRA can pay taxes. The entity can pay taxes. In other words, it might be set up as a C corporation or an LLC taxed as a C corporation, and that would be fine. That means the dividends, the entity pays the tax, and the dividends coming from that entity back to your IRA are just normal investment income, and that's free of tax. The problem with this is you might have other partners, and probably would have other partners running the business, and they may not want the double taxation, because if they own a part of the business and the business has to pay the tax, then when they take it out in the form of salary or dividends, they're taxed again. So they may not want to do that, but it's a possibility for your IRA to escape UBIT. Another excuse me, my voice keeps going out. Another possibility is to loan, don't own. I like this because if you loan money against a property or to an entity that owns a debt finance property, then you don't own it. You just have a loan against it. And that means that there's no taxation to your IRA. Loaning money out does not cause taxation. It's when the IRA borrows money, not when it loans money out. But again, a disadvantage here is that if you want to make a whole bunch of money, then you may not be able to charge enough to make the money you want to make, because there are things like usury. Usury is interest collected, charged, or received in excess of a legal amount, and you don't own the property, so you can't control what happens to it. But it's a way to escape taxation. Thirdly, you could take an option. If you have an option on a property that has debt against it, that's just an option. You don't have to exercise your option. In fact, a lot of times people will buy an option in their IRA against property and later sell it at a profit. That's not selling the property at a profit, that's selling the option at a profit. But if you exercise the option, of course, by definition, then you're going to own the property, and if it's subject to debt, then that's going to be debt finance income. So again, there's a lack of control, and somebody else has to own the property, and you just have an option on it. So that may be a solution, but it may not be a good one. Fourth, you could bring on a money partner. By that, I mean not borrow money from somebody, but include them in the deal as a partner. And you can structure your partnership any way you like. And this may work to avoid unrelated debt finance income. The problem is you got a partner. And any of you out there who are listening who might have had negative experiences with partners, then you know what I'm talking about. Sometimes the IRS may be a better partner because they're a silent partner. They're not going to care whether you paint the house purple or sell it or don't sell it or whatever. You have to pay, but it may be more efficient to have the IRS as your silent partner. So when I say what accounts are best for doing a UBIT transaction, that's a little bit of a weird way to put the question. What I mean is, if you're going to do a transaction and you have a choice between different types of accounts, which account would you consider first? Well, because the payment of taxation by the IRA does not give any break on taxes when the income is distributed, if you're going to pay taxes in your IRA, you might try to pay taxes in an entity where you can later get money out tax-free if it's a qualified distribution. So the one that comes immediately to mind, of course, is the Roth IRA, where if you're taking a qualified distribution, it's tax-free. So if a Roth IRA does a transaction that causes it to pay unrelated business income tax, at least it doesn't have to pay again. You don't have to pay personally again when the distribution is a qualified distribution. But there are other types, and that would include the health savings account, great type of account, by the way, an education savings account, or a CISA or Coverdell, and a Roth 401k. And all four of those types of accounts, if you have a qualified distribution, you can get it out tax-free. So if they pay taxes, at least you're not paying double taxation. Something to think about. Is doing some other questions that I run into, is doing a UBIT transaction the same thing as a prohibited transaction? Absolutely not. It is not the same thing at all. A prohibited transaction will blow up your IRA. A UBIT transaction will only cause your IRA to owe taxation, not you, but your IRA. And so UBIT is under sections 511 through 514 of the Internal Revenue Code, and the prohibited transaction rules are under section 4975 of the Internal Revenue Code. They're two completely different things. And if you read the IRS publications, sometimes you might get the impression that they are the same thing or derived from the same issues, and they're just not. Why make an investment in an IRA if it will be taxable? That doesn't make any sense. Why should I have my IRA pay tax? Well, it might make sense. It depends on your personal tax situation, the after-tax return you're going to get from the investment, your time frame to retirement, and your future investment strategy. Let me break that down for you a little bit. In my personal tax situation, I'm already in the highest tax bracket. So if I make a deal and assuming I don't need the money from the deal to live on. If I make a deal and it's debt finance, or even if it's unrelated business income, why in the world would I care if I did it in my IRA and my IRA paid taxes? Because I'm going to pay those taxes if I do it outside of the context of the IRA. So if I'm going to pay the same or less in the IRA, my overall wealth circumstances will improve if I do it in the IRA versus my personal tax situation. Now, if I need the money, of course, that's something different. But especially if I'm doing it in a Roth account or an HSA or a Coverdell, it's a good deal for me. The after-tax return, now if you could get an 80% return, an 80% return on your money, and you could get a 12% return by not having debt financing. Which would you rather? I personally look at the bottom line. If the investment is a great investment and will have a high return after calculating the effect of paying the taxes to the IRS, I'd rather do it. But then I'm kind of think differently than a lot of people, I guarantee you that. But your time frame to retirement, if you're like a lot of Americans who actually not saved sufficiently for retirement, sometimes you have to do things that will juice up the account, and having your IRA pay taxes may be the very thing you need to build your account up. Also, your future investment strategy. If you do an investment outside of the context of the IRA, you pay taxes on it unless you 1031, and even then you're going to pay taxes on the income from it. So you pay taxes on it, you reinvest it, you pay taxes on it, you reinvest it, you pay taxes on it. At least if you're in the IRA world, the IRA may owe taxes on it, but then if your future investment strategy doesn't include debt finance property or unrelated business income, then you basically given your account a boost, and now you can invest it in any way you like, including ways that don't cause any taxation at all. So this is a bit of an advanced way of analyzing things, but it's a good thing to think about, and you have to know this stuff anyway. If an investment would be taxable to an IRA, who pays the tax? The IRA must pay the tax. This is not your taxation, this is the IRA's taxation. So don't get confused on that. What is the tax rate that IRAs must pay? Well, quite frankly, it's pretty high. IRAs are taxed on the tax rate for trust, which goes up to the top marginal tax rate of 37% at $12,750 of taxable income for 2019. Capital gains, of course, are taxed to the usual rules for long-term versus short-term capital gains, except only the debt finance portion of the gain is taxed. So let's take a circumstance and explain that part. If you have a short-term capital gain, it's going to be taxed as ordinary income to you. So to the person who has the short-term capital gains. So that's going to mean short-term capital gains in an IRA with debt finance property is going to be higher, whereas long-term capital gains are going to be much cheaper. I think the max there is 20% if I'm not mistaken. But keep in mind that only the debt finance portion of the gain is taxed. Earlier we discussed the fact that if you were 50% leveraged on a piece of property on average, then the 50% that your IRA doesn't have debt leverage, the income from that 50% is tax-free, whereas the debt finance portion is taxable because that's not your IRA's money, that's somebody else's money. So if you had a taxpayer that was in a high tax bracket and had a capital gains, then in the outside world, outside of the IRAs, it's going to be taxed 100%, but in the inside of the IRA world, it's going to be taxed at whatever the debt finance portion is, in this case, 50%. So you can have a situation where it's more advantageous, a lot more advantageous for the IRA to do the transaction when you look at an overall wealth picture. Where can you get some more information? If you're a nerd like me, you read IRS publications on the weekend for amusement's sake, so the IRS publication is $5.98. If you're really a nerd or you're a CPA or tax attorney, you may refer to sections 511 to 514 of the Internal Revenue Code. The form that the IRA has to fill out and pay taxes with is Form 990-T, as in trust. And the IRS Form 1041 Schedule D has some very useful information about taxation of IRAs and that sort of thing. Now I want to wrap up this presentation with 3 brief examples of how this worked out for clients of Quest Trust Company. And hopefully that'll give you the idea that it's not all evil. It's something not necessarily that I'm advocating for people to do, but at least I don't want you to throw the baby out with the bathwater. So let's look at these 3 circumstances. One way, as we discussed, if you have a small IRA and you need to build it up because you're closer to retirement than you have saved money for, then debt leveraging may be a way to do it. So I had an example of, I used to be a fee attorney for American Title Company, and basically I had a lady call me up and she said, "Hey, I got a house under contract for $75. Can you close it?" And I went, "Woohoo! That sounds like a big commission to me." But I started to dig into it, and basically it was on the tax rolls for $302,000, but it was subject to $97,000 of delinquent taxes, and the tax authorities were coming after the property to foreclose on it. So what she did is she bought the property for $75 plus closing costs. Cost her about $3,036.50. So she put $3,040 into her Roth IRA and let her Roth IRA enter into the contract to buy the property. Now, ostensibly it's worth $302,000, but it's got a lien that's being foreclosed on it. So it was a exciting time, but in under 4 months, she sold that property for a profit to the IRA of $43,500. Now, because this was short-term capital gains, the IRA had to pay taxes on its portion of that profit. So it ended up paying about $13,500 in taxes and unrelated debt finance income taxes, capital gains, short-term capital gains. So the net profit on that $3,000 investment was only $30,000. Everybody say, "Oh, poor IRA." In my mind, going from $3,000 to $33,000 in a matter of 4 months is worth some risk and worth the IRA owing some taxes. But that's just me. Next example, I had a client that liked to buy hunting property. He'd been doing it outside of the IRA for many years. So he'd buy hunting property and then hold it for a period of time and then sell it at a profit, because we're in Texas and this was in Texas and we like to kill things in Texas, whether animals or people or whatever. So hunting property is very valuable. So he found a couple hundred acres he could buy for $438,900. He got a non-recourse 8.15% loan with fixed annual payments, and the loan amount was $307,000. And the total cash that came from his IRA, it was $137,391 from the time he bought the property in the IRA and the time he sold it, which he did 18 months later for $614,460 cash. That meant that his IRA profited $124,462 before having to pay tax. But because he held it for more than a year, this was long-term capital gains. So the tax he ended up paying was only $12,591. I say he, I mean his IRA, meaning his net profit after paying the tax was $111,871, which is an 81.43% return on his investment in the IRA, when everybody else's IRA in that time period went down 40 to 50%. So I think he did pretty good, even after paying the IRS its share. Finally, we've said that private placements, like entities that are not taxed, often invest in things that would cause the IRA to pay taxes if it was done directly in, and because it's a non-tax entity, it also occurs when the IRA invests in an entity that has debt finance property or runs a business. So here's an example of one that basically happened. The initial investment was $100,000, and at the end of the partnership, which was approximately 2 years, the total partnership distributions were $148,600. So that means there was a profit of $48,600, and almost all of those profit were long-term capital gains. So what did that mean? That means that, and I don't remember what the debt finance part was, but that means that there wasn't very much taxation, even if it was 100% tax, which it wasn't. But even if it was 100% tax, it would be a maximum of 20% of $48,600, and that would be if it was 100%. If it's less than that debt leverage percent, then it's going to be even less, as opposed to 20% of 100% of the profits if I did that outside of my account. So I just took the money and reinvested it, or we took the money and reinvested it at $150,000. So I added a little bit and rolled it into the next project. Now, the nice thing about this is that I did nothing. There was no rehab of the property. There was no anything. We simply bought property for and sold it later for a profit. And so it was a super good deal. And it just goes to show that sometimes you don't run away from something because you don't understand it. You just get educated on it and see if you can make you wealthy. So there's my contact information, quincy.long@questtrust.com. That's quincy.long@questtrust.com if you want to reach out to me, or you can call our office at 855-FUN-IRAs, because I think self-directed IRAs are quite fun. That's 855-386-4727. Thank you for your attention today, and you have a wonderful day, and we'll see you at a Quest event sometime soon.